Hello everyone, welcome back to Tech News Today. I'm your host Dewan. In this video, we're going to talk about one of the biggest stories in tech industry right now, the collapse of Silicon Valley Bank. SVB was one of the largest banks in US, serving thousands of startups and venture capitalists. But last week, it fell spectacularly after a run on deposits that drained its capital. What caused this crisis? How has it affected the tech sector and wider economy? And what are the implications for future of banking regulations? Stay tuned as we explore these questions and more. Silicon Valley Bank was founded in 1983 as a niche leader for emerging technological companies. Over the years, it's expanded its services to include deposit accounts, credit cards, foreign exchange, wealth management, and more. It also established a relationship with some of the most poignant venture capital firms in Silicon Valley, such as Sequoia Capital, Andreessen Horowitz, and Y Combinator. By 2020, SVB had become one of the top 50 banks in America by asset, with over $100 billion on its balance sheets. It had more than 30 offices across Europe, Asia, and Israel. It served over 50% of venture-backed companies in America, including household names like Airbnb, Uber, Stripe, and Coinbase. The trouble for SVB began earlier this month when interest rates started to rise sharply due to inflation fears and expectations of tighter monetary policies from the Federal Reserve. This created a squeeze for many tech startups that had borrowed heavily from SVB at low rates to fuel their growth. As their costs increased and revenue declined due to their slowdown in consumer spending, they faced difficulties in repaying their loans or raising new funds. To make matters worse, some of the investors began to lose confidence in SVB's financial stability after rumors circulated that it had exposure to some risky cryptocurrency schemes. These rumors were later confirmed by an anonymous whistleblower who leaked internal documents showing that SVB had lent millions of dollars to crypto exchange and hedge funds without proper collateral or oversight. As panic spread amongst SVB clients, they started to withdraw their deposits en masse, this creating a liquidation crunch that the bank depleted its capital reserves below regulatory requirements. Despite efforts by the Federal Deposit Insurance Corporation and other regulatory claims the situation and provide emergency funding, SVB was unable to stop the run on its bank. March 10th, SVB announced that they had filed for bankruptcy protection under Chapter 11. This makes the largest failure of U.S. banks since Lehman Brothers collapsed during the financial crisis of 2008. SVB collapse sent shockwaves across the tech sector and wider economy. Many startups that rely on SVB for financial found themselves cut off from credit or facing higher interest rates from alternative lenders. Some were forced to lay off their staff, delaying product launches, or shut down altogether. Others scrambled to find new banking partners or switch platforms for their payment processing, foreign exchange, or wealth management needs. Venture capitalists who invested in these startups also suffered losses or write-downs on their portfolios. Some VC firms were also exposed to SVB's debt or equity through direct investments or syndicated deals. They faced challenges in raising new funds or exiting their existing position among market uncertainty. So let me know what you think about all that in the comments section. I apologize for the few flub ups. I'm getting back into the swing of things. As you can tell, my content is changing. As I have changed, I have grown up, and different things matter to me now. If you're sticking with me, I appreciate you. If we must part ways, I understand. With that being said, everyone be safe, and I'll see you next time.